The US dollar got absolutely smashed yesterday. It fell around 0.8%, which was one of its biggest moves in months. But here's what makes this really interesting. The Fed actually sounded more hawkish. The minutes from their last 3 meetings showed that 3 officials wanted to raise interest rates by 25 basis points, and several other officials said that rates may need to go higher if inflation stays elevated. So why did the dollar fall, you may ask? Well, the US Treasury announced that it's going to double its long-term loan buybacks from around $2 billion to at least $4 billion in the next couple of months. That pushed the Treasury yields lower. And when the US yields fall, the dollar becomes less attractive to hold. So you had this really unusual situation. The Fed hawkish, the Treasury supporting the bond market, yields being lower, and the dollar down. And traders need to understand this. You can't just look at the Fed's interest rate decision and assume you know what the dollar's going to do. A large part of why currencies move is expectations, and sometimes the market reaction isn't about what the central bank did. It's about what happened to yields, positioning, and expectations, but more importantly, anticipation for what's coming next. That's why yesterday was such an important lesson for FX traders. Don't just trade the headline, understand why the market's moving. Because yesterday, the Fed sounded hawkish, yet the dollar still fell.